This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Vital signs, which industries win and which lose under the new GOP healthcare plan.
Digging deep, why key players in the multi-billion-dollar equipment manufacturing industry are gambling on a better future.
Women on Wall Street. One of the world's largest asset managers wants more women in the boardroom, and it is using the iconic bull on Wall Street to get its point across. Those stories and more tonight on Nightly Business Report for Tuesday, March 7th.
Good evening, everybody, and welcome. Wall Street, Washington, and Main Street were all focused on health care following the release of the House Republican plan to replace the Affordable Care Act. As we reported last night, insurers will still cover people with pre-existing conditions and allow children to stay on their parents' plans until the age of 26. The big change? Tax credits under the new plan are based on age and get phased out with people with higher incomes. In Obamacare, income and the cost of your insurance determined your tax credit. Bertha Coombs takes a look at the potential winners and losers.
For many of the ACA's winners, older, low-income people, it would mean lower tax credits, while Obamacare's losers, higher-income people, would gain a tax break for insurance, as well as see several taxes on high-income earners to pay for Obamacare repealed.
We need to equalize the tax treatment for the purchase of coverage. Those, again, in the employer-sponsored market, they get a tax benefit for buying health coverage. Those folks that are out there in the individual and small group market, no tax benefit. And that's what this plan would do.
Here's how it would work in a high-cost market like Mobile, Alabama. A 60-year-old earning $20,000 a year now gets $13,200 in exchange subsidies, according to the Kaiser Family Foundation. Earning $40,000 gets you about $10,000 in subsidies. At $60,000, nothing. Under the GOP plan, $20,000 and $40,000 earners would only get $4,000 in tax credits, or 60 to 70% less. Those earning up to $75,000 would now gain $4,000. But insurers would also be allowed to charge 60-year-olds 5 times higher rates than younger people, up from 3 times under Obamacare.
What happens when people can't afford insurance is the only people that tend to buy it are the sicker people. So this is not only going to cover fewer people, but it's actually not going to be good for the risk pool either.
The GOP plan also repeals the ACA employer mandate to provide coverage. But for companies like RHA Health in North Carolina, it's a mixed bag because the so-called Cadillac tax is not repealed, just postponed until 2025.
Within the benefits world, the Cadillac tax has been some sort of kind of mythical creature that may or may not happen. I feel that we already made strides to reduce kind of the value of our plans.
And for now at RHA, they're planning to offer more high-deductible plans no matter what happens in Congress.
It hasn't gotten any cheaper over the past 14 years, okay? The reality is it goes up.
Until the Congressional Budget Office releases its report, there are no official estimates on just how many people could lose coverage under the GOP plan or how much it costs. Bertha Coombs, Nightly Business Report, New York.
Let's turn now to Chris Meekins for more on the potential changes coming to the healthcare landscape and who might the winners and losers be in the healthcare sector. Mr. Meekins, welcome. Good to have you with us. Those stark numbers that Bertha just showed on the screen, comparing the subsidies under the Obamacare plan versus the tax credits under the GOP House plan, suggests to me that fewer people are going to be buying health insurance one way or another. Is that going to hurt insurance companies? And if so, which ones?
Well, I think if you look at it, the people over age 50 to 65, you're right. They're going to get less of a credit. They're going to be charged more. It's a negative for them. For those under age 40, actually, the tax credit for individuals may be enough to cover the entire premium. So these people's premium will be paid just by the tax credit. As a result, you could see people under age 40 entering the market and people over age 50 to 65, which tend to be higher utilizers, exiting it. As a result, insurers who are involved in the individual markets, Anthem of the world, United has a little exposure, Aetna has some exposure in that space. All of them could be benefit because the risk pool is going to get better because it gets younger.
And what about hospitals? Because near term, obviously a lot still needs to be discussed and it may change before the vote goes through. But how do you view the hospitals and the critical care aspect of this?
Sure. So in the House Republican plan, if it becomes law, they removed the DSH cuts, the disproportionate share hospital cuts that were part of the Affordable Care Act for non-expansion states in 2018 and other states in 2020. Additionally, the Medicaid expansion population over the next 3 years stays. Additional states that haven't expanded Medicaid, like Florida, like Texas, could expand. Additionally, they get an additional $10 billion for states in general to help with the safety net. As a result, you could see hospitals actually benefit over the next 18 months to 2 years in revenue. Now, outside of that, when the Medicaid expansion starts to wean off and you start to move towards a per capita model, that would probably put pressure on hospitals, which would be negatively impact their bottom line.
And so, some of them went down today. I know Tenet was one of the ones that took a big hit in the marketplace today. A couple of other industries that I know you follow, one would be pharmaceutical and biotech. This bill doesn't have much pertaining to that. The president tweeted earlier today that he has a separate plan coming that will reduce the prices of drugs. But does this this bill, have any effect that you can see on biotech or pharma?
The bill does a couple things. Number one, it repeals a tax on branded pharmaceutical industry that's $30 billion over 10 years. That's bigger than the medical device tax that's only about $20 billion over 10 years that we've heard a ton of folks talk about. Additionally, it doesn't touch anything on drug pricing, which is really the threat of potential policy action on drug pricing has been holding back a handful of these stocks over the last 18 months from when presidential candidate Hillary Clinton tweeted about it. We feel really optimistic about where biotech's going to be based on the fact that drug pricing policy actions are unlikely in 2017. We also believe repatriation, if that happens as part of tax reform, you could really see a lot of cash flowing back into the U.S. and acquiring some of these biotech guys. It's one of our most optimistic areas.
All right, Chris, thank you very much. We appreciate your clarity tonight. Chris Meekins with FBR.
Thanks.
As Ty just mentioned, drug stocks had a down day after President Trump took to Twitter promising to cut the price of medicines. He tweeted that he's working on a, quote, new system where there will be competition in the drug industry. Pricing for the American people will come way down, end quote. The president offered no specifics, but it was enough to send the shares of the biotech ETF, ticker symbol IBB, down by more than 1.5%.
The president has also pledged to invest in infrastructure and to renegotiate trade deals, and changes to either of those could ripple through the massive construction equipment building industry. Jane Wells reports tonight from Las Vegas.
The equipment manufacturing industry is a $160 billion business in the U.S., but it's been pretty lackluster. Construction hasn't been strong enough to require a lot of new machinery. Oil and gas have not been great. And down on the farm, well, farmers say they're not making any money. But they're gambling on a better future in Vegas at ConExpo, the largest gathering of large machines held every 3 years. Everyone's talking about an infrastructure bill.
It could be $1 trillion investment, so we're looking at a year that could be a 5% increase.
The critical thing first is it's got to pass, and then it has to be funded. And in the past, a lot of times they have passed but not funded it on a long-term basis.
But even as manufacturers tout ever smarter and more efficient machines, they even have a 3D printed excavator here. All the hope for potential infrastructure spending is being offset by concern over a border tax and maybe a trade war.
35% of our business depends on foreign trade. So that would just be catastrophic for this business.
It would be devastating. I mean, these are large global exporting companies that rely on the rest of the world for their sales.
For example, Most of our competitors, Caterpillar, Deere, source their engines as we do overseas.
Bobcat is owned by Korea-based Doosan, and North American President Rich Goldsberry says his bosses are a little confused by Washington.
So when I talk to some of our Korean executives, they say, well, can we build the wall? Can we help build the wall? And I go, it isn't quite that simple.
Deere CEO Sam Allen said he would tell President Trump yes on cutting taxes and regulations, but be careful about trade.
Retaliate against others, but don't put barriers up that then cause them to retaliate against us.
You see, even though most of Deere's sales are domestic, many of its customers are farmers who export crops to China, Canada, and Mexico. And if a trade war hurts farmers, it hurts Deere. And the feeling at this convention, it could hurt everybody. For Nightly Business Report, Jane Wells, Las Vegas.
On Wall Street, stocks saw their first back-to-back declines since January. Investors were not only analyzing the new healthcare blueprint, but also the prospects for tighter monetary policy. The Dow Jones Industrial Average fell 29 points to 20,924. The Nasdaq was off 15, and the S&P 500 dropped 6. Oil prices held steady today at $53 a barrel, despite the expectation that U.S. production could increase.
And that expectation for a rise in production was partially offset by comments from Saudi Arabia's oil minister, who said the fundamentals of the crude market are actually improving. Brian Sullivan spoke to him at CERA Week, a major oil conference in Houston.
The heaviest hitters in the world of oil and gas are here in Houston, Texas, and the heaviest hitter of all is the Minister of Energy for Saudi Arabia, also the chairman of Saudi Aramco, Khalid Al-Fallah. He spoke exclusively with CNBC, and the heaviest topic was about OPEC's production cut agreement, and I began by asking him whether he thought that production cut deal would continue past the deadline in May.
It's premature to discuss. We're only 2 months and 1 week into the agreement. I think performance has been good overall. If you look at the numbers in total, compliance has been high, certainly among the OPEC countries, and the non-OPEC countries are getting up there.
So with some optimism that OPEC production deal will be continued, we asked him if he thinks that the worst has been seen in oil.
I think the fundamentals are coming back into line. There are inventory drawdowns. I think demand is picking up healthy. The global economy is doing well. And the investment flows have slowed down significantly, which may be an overshoot, but certainly they're not going to cause this glut to stay with us.
So there you have it, some optimism that maybe the worst has passed us in the oil world because OPEC will be able to do something it has struggled to do in the past, which is maintain an agreement between countries to cut production. But there is more optimism this year than there was last year when oil was below $30 a barrel at the same conference. For Nightly Business Report, I am Brian Sullivan in Houston, Texas.
Still ahead, an airline that no longer wants to fly under the radar.
Hawaiian Airlines set to grow internationally. Where is that growth going to? I'm Phil LeBeau in Honolulu. That story coming up next.
After years of watching airlines in the United States merge to become bigger and even more profitable, Hawaiian Airlines is flying in a different direction, growing while remaining independent. But expanding from the islands of Hawaii to markets around the globe is a challenge. Phil LeBeau, usually in Chicago, sacrifices profoundly to take us to the tarmac in Honolulu.
Hawaiian Airlines is the niche carrier trying to break the mold and become more than just an airline dominating flights to and around the islands of Hawaii.
We're about 4 times larger than we were, say, 6 or 7 years ago, and that's all been organic growth. And we've done that by growing principally into Asia with our fleet of new wide-body aircraft and employing more people here locally in the community and bringing the Aloha spirit around the Pacific Rim.
Hawaiian's passenger growth over the last decade has been impressive, fueled in part by its continued dominance of short-haul flights between the islands of Hawaii and upgrading its planes to attract more travelers along the Pacific coast. But as Hawaiian targets expansion to the eastern U.S. or in huge Asian markets like Beijing, analysts are skeptical it can avoid turbulence that comes with having a smaller balance sheet.
Cash is clearly king when you have an aggressive expansion plan. If you have a thin balance sheet, if you have a thin cash level, if you have only an okay cash flow, things can go wrong very quickly.
Hawaiian's growth comes at a time when many of its competitors have merged to become larger and stronger, which raises the question, can Hawaiian stay independent and become a truly international airline?
We think we can continue to grow. I think what's important for our business is that we run the best possible airline that we possibly can as an independent airline.
Growing beyond the South Pacific with global ambitions to spread the Hawaiian brand. Phil LeBeau, Nightly Business Report, Honolulu, Hawaii.
Dick's Sporting Goods issues a disappointing outlook, and that's where we begin tonight's market focus. The athletic apparel retailer posted quarterly profit and revenue that topped expectations, citing strength in e-commerce and same-store sales. But the company followed with weaker than expected guidance for the current quarter, adding that it plans to open additional stores this year while cutting 20% of its lower volume vendors. Sales were off more than 8% to 4808. The S&P 500 will get a new edition. Next Monday, satellite TV provider Dish Network will be added to the index, replacing linear technology, which is being bought by semiconductor company Analog Devices. Dish shares rose 4% to $64 even.
Well, Hewlett-Packard Enterprise will buy the flash memory technology company Nimble Storage for more than $1 billion. The deal is expected to provide HPE with a larger array of storage offerings for its enterprise customers. Hewlett-Packard shares off 1% at $22.82. Nimble Storage, really nimble today, surging 46%. Yes, you heard me right, to $12.58. H&R Block said a lower number of tax filings at the IRS caused the company's revenue to drop. The company also reported a wider loss, but the results were better than Wall Street's expectations. Shares up more than 8% in after-hours trading, but they ended the regular day down a fraction at $20.84.
State Street Global Advisors is making a new push for more companies to add more females on their corporate board. The fund giant installed a bronze statue of a defiant young girl leaning towards Wall Street's iconic charging bronze bull as part of its push for more women directors. The company says it would start voting against boards if a company failed to take steps to increase the number of members on its boards who are women. State Street Global Advisors Deputy Chief Investment Officer Lori Heinel joins us now to talk more about her company's push. And we should note that State Street has 3 board members who are female on their board of directors. Welcome. It's a pleasure to have you with us tonight, Lori.
Yes, thanks for having me this evening.
Now, you carry a lot of clout. You're one of the largest asset managers globally that there is. And you're going to give companies time to make these changes, but you're also going to be watching them very closely.
We are, as a steward, as you say, of $2.5 trillion, we believe it's our duty to improve the outcomes for shareholders. And one of the ways that we do that is by engaging aggressively with board and company management around those issues that we think will ultimately drive performance. And diversity is one of those issues.
Mm-hmm.
So let's delve a little deeper there. This isn't just because you like girls. It's because studies have indicated that companies that are more diverse in terms of representation of women and others perform better.
That's right. There have been numerous studies, one in particular by MSCI in 2015, that found that companies with more diversity in their senior leadership actually outperform those without that diversity by more than 36%. We've also seen studies that suggest that these companies take fewer risks in the sense that they don't have as many sort of headline news items that would bother them from a governance perspective. So we think that it's both a return enhancement opportunity, but also a risk management opportunity.
You've been on Wall Street for a long time. I've covered Wall Street for a long time. Are you surprised that there hasn't been more diversity in the boardroom? That's the first question. And two, what do you think the reaction is going to be when these letters go out to these companies?
So personally, I'm very surprised, right? I've been in this business for more years than I'd like to share, but the bottom line is these are issues that we've been talking about for a long time, and I think the challenge is that we need to tackle some of the root causes. So some of the issues around advocacy and sponsorship and really holding leaders accountable. And what's really critical is that there's a real business case here. If the bottom line is that investors will be better served because there will be diversity of thought in the boardroom and ultimately in senior management as well, that's a better outcome for investors. And I think people haven't really responded to that business case the way that they need to.
30 seconds, Lori. What will you do if a company that you approach doesn't comply with your requests?
Yeah.
Where's your hammer?
Yeah, well, so first and foremost, we want those companies to hear us and to make those tangible steps to broaden the diversity on their boards. But in the end, if we aren't able to get the satisfaction that they're moving in that direction, then we will vote against those committees and make our voice well known.
Well, we will be keeping track. Thank you, Lori, for joining us tonight.
Thank you.
Lori Heinel with the State Street Global Advisors.
And coming up, high-tech takeout. Why the fast food industry is getting caught up in the digital craze.
Ordering fast food on your phone seems like a simple enough idea. It's worked well for some companies as they try and gain back the business of millennials, among others. Recently, McDonald's started to try it out. But is it too little, too late? Susan Lee has more.
Burgers, pizzas, burritos, and coffee. The battle for your fast food dollars is going high tech. The world's largest restaurant company, McDonald's, is joining the digital craze, offering mobile order and pay to 20,000 restaurants this year and testing out delivery. McDonald's joins Starbucks, Domino's, Panera, Taco Bell, and others catering to the changing habits of consumers.
Businesses have to work harder around the experience to entice customers because technology is making it easier for people to stay at home. If you want to see a movie, you can put on Netflix as opposed to go to a movie theater, for example. And so we need people out and about. That's where we prosper in and around our restaurants.
According to the NPD Group, digital food ordering grew 18% last year and now accounts for almost 2 billion food service visits. And it's all about dinner, accounting for half of digital orders. Deals and promotions also play an important part, with consumers twice as likely to order on a deal when there's a coupon, special, or discount offered. Domino's and Panera were early adopters of mobile ordering, which has increased their business and helped their stock surge, according to analysts.
Pizza guys have a head start, and they should be able to add to their food types that work along with the pizza. But also Mexican works well. There's no reason why Chipotle, for instance, can't benefit from digital and delivery down the road. Panera's food obviously travels well, and they'll continue to benefit.
So is McDonald's too late to the game?
We have put a fully integrated plan together. So it isn't just the consumer-facing technology, getting a mobile app that's more engaging and useful, but it actually links all the way through to the kitchen and the operations.
But that's not to say that there aren't challenges. Going mobile makes it easier to order, but it also means more orders to fill. Starbucks and Chipotle recently experienced problems at some of their outlets. Mobile orders overwhelmed the kitchen staff, resulting in long lines and frustrated customers, something that McDonald's doesn't want to repeat. I'm Susan Lee for Nightly Business Report.
And on that note, that does it for Nightly Business Report tonight. I'm Sue Herrera. We want to remind you this is the time of year your public television station seeks your support.
And we're grateful for it. I'm Tyler Matheson. Thanks for your support. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate. Disrupt, to move us all forward, to explore a different perspective. At NASDAQ, we connect the world, its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.